It was the late 2000s, and in the suburban sprawl of a quiet town in Texas, a 17-year-old named Danny Walker was just like any other high school senior. Except for one thing. Danny had figured out how to hack the financial system and make millions off credit fraud, an empire that would span states and almost go undetected for years. Danny wasn't a typical tech nerd. Sure, he had a love for computers and spent most of his free time on forums, learning about security flaws and coding tricks, but he also had a natural charisma. He wasn't the awkward, socially isolated hacker type. He had friends, he was well-liked in school, and he could charm anyone with a smile. But beneath that veneer of normality, Danny was scheming, building a complex fraud operation that would make even seasoned criminals cringe. The spark, a school project gone wrong. It all started with a simple high school project. Danny was tasked with researching how banks and credit card companies assess risk when they approve credit. A standard assignment for any senior in an economics class, but Danny, ever the curious mind, decided to dig deeper. His research led him to a startling realization. Banks and financial institutions relied on automated systems that weren't as secure as everyone thought. There were loopholes, massive ones, and they weren't being properly monitored. With this knowledge, he began brainstorming how he could exploit the weaknesses in the system. Danny started small. He crafted fake identities, using a mix of public information and creative guesswork to fabricate entire credit profiles. He then applied for credit cards using these profiles. The first few attempts were a bust, denied for minor discrepancies, but each rejection taught him something new about the system's weaknesses. Danny fine-tuned his approach. His hacking skills came into play as he learned how to manipulate the data sent to credit bureaus, how to cover his digital tracks, and how to create fake addresses and phone numbers that could pass automated verification checks. He was still a high school kid, so he needed to stay under the radar. He started off by opening small lines of credit, store credit cards, department store accounts, anything that didn't require extensive verification. These were the kinds of cards no one really checked carefully because they often had low limits and seemed harmless. But Danny wasn't interested in low limits. He was testing the waters. After a few months, he had a dozen or so cards, and he'd started building a small but respectable credit history for his fake identities. The $50,000 loan one night, Danny was browsing a forum on identity theft when he saw a post about a loophole in personal loan applications. Some financial institutions were offering personal loans online without requiring face-to-face verification, and a lot of them didn't cross-check the details through robust background checks. These lenders didn't require proof of income, didn't check for previous debts, and allowed applicants to list any phone number or address they wanted. Danny's eyes lit up. This was it. He quickly built up a new identity, complete with a fake job, a fake salary, and a fabricated social security number. With all the pieces in place, he applied for a $50,000 personal loan online. The application was approved in a matter of hours. The money was transferred into a bank account Danny had set up using another false identity, and within days he withdrew the funds and used them to buy luxury goods and stockpile cash. At first, Danny was overwhelmed. The money was unreal, more than he'd ever seen in his entire life. But he was smart enough to know he couldn't stop there. He needed to scale up. The key to making millions wasn't just taking out loans or credit. It was manipulating the system so that the money would never trace back to him. Danny knew that to truly succeed, he had to keep expanding. He began to recruit friends to help him. He'd give them a portion of the proceeds in exchange for using their personal details to create fake identities. Some of them were just in it for the thrill, while others were motivated by the money, but none of them fully understood the scale of what they were getting involved in. Danny was a master of convincing people to trust him. He always had a way of making it seem like no one could possibly get hurt. With his network in place, Danny began applying for bigger loans. Not just personal loans, but business loans, car loans, even home loans. He used the same tactic: a fake company, a fake income statement, and fabricated business plans. He created dozens of fake businesses, small startups, that supposedly needed capital to expand. When a bank approved a loan for one of these businesses, Danny would then use the funds to buy assets, from high-end cars to real estate, to make his fraudulent empire look legitimate. As Danny racked up credit lines in multiple fake names, he also began using stolen credit card data to purchase items, sell them online, and convert the funds into untraceable cryptocurrency. He would frequently launder money through offshore accounts and online marketplaces that didn't ask too many questions. By now, he was living a lavish lifestyle, owning expensive cars, throwing lavish parties, and even buying property, an apartment complex in Dallas with cash, all on the back of stolen identities and fraudulent loans. Danny had built a multi-million-dollar empire, but in his bid for more, he started to get reckless. He expanded too quickly, taking out massive loans, sometimes upwards of $500,000, using fake company names and false paperwork. He applied for lines of credit with large banks, often forging paperwork that made his companies appear as if they were highly profitable. Banks were reluctant to deny loans to businesses that appeared successful, and soon Danny was getting approved for sums so large that even he was overwhelmed. The problem came when Danny applied for a loan of $3 million for a new business venture, an online tech company that didn't even exist. The bank, suspicious of his previous applications, flagged the loan and initiated a deeper investigation. The deeper they dug, the more they found. It was a mistake Danny never saw coming. As investigators started to trace the web of fake companies, false identities, and illegal transactions, they discovered a pattern. The same phone numbers, the same addresses, the same IP addresses, all pointing back to Danny. But he was too deep in the game to escape unnoticed. Authorities tracked down the rented apartments, the fake businesses, and even some of Danny's associates, all of whom were caught and arrested. The FBI launched a full-scale investigation into Danny's operation, and after months of work, they raided his family home. Danny, who had once been the picture of suburban normality, was arrested in a quiet, early-morning operation. At the time of his arrest, Danny's fraudulent empire had raked in an estimated $42 million. He had a fleet of luxury cars, over 30 credit cards in different names, multiple properties, and millions stashed in offshore accounts. But his downfall was swift. Danny was charged with identity theft, wire fraud, money laundering, and conspiracy. Given his age, he was initially tried as a juvenile, but the severity of the crimes led to him being charged as an adultee in federal court. The media frenzy surrounding his arrest was intense. Headlines like, "Teen hacker makes millions in credit fraud," blared across the nation. Danny became infamous, not just for his crime, but for his audacity and skill. In a time when cybercrime was growing rapidly, his story was both a warning and a reminder of how vulnerable the financial system could be. Danny was sentenced to 25 years in federal prison, but his case sparked a nationwide conversation about cybersecurity, the vulnerabilities of the credit system, and how teenagers could, with the right skills and knowledge, exploit the weaknesses in what was thought to be an impenetrable system. Though Danny's empire came to an abrupt and spectacular end, his story remains one of the most remarkable tales of financial fraud in the digital age. In the early 2010s, during the aftermath of the housing bubble crash, a 16-year-old named Tyler Matthews from a small town in Ohio became one of the most notorious mortgage fraudsters in U.S. history. What started as a curious side hustle turned into a sophisticated, multi-million-dollar empire that took years for authorities to untangle. Tyler's story would serve as a chilling reminder of how vulnerable the mortgage system was and how a brilliant but reckless teenager could exploit it. Tyler Matthews wasn't your average teenager. He was the son of a small-town mechanic and a high school teacher, and while his family was far from wealthy, Tyler had always been determined to live a life above his means. At 15, he developed a keen interest in business, economics, and, surprisingly, the housing market. He would spend hours researching real estate prices, mortgage rates, and loan structures on financial websites. By the time he was 16, Tyler was practically obsessed with the concept of homeownership, and more importantly, how people could leverage debt to accumulate wealth. Tyler's fascination with mortgages began when he noticed that many of his classmates' parents were house hunting or refinancing their homes. He quickly realized that people were making huge financial decisions based on trust in mortgage brokers and lenders who, in many cases, didn't check as thoroughly as they should. A high school project on personal finance piqued his curiosity even further. What exactly did mortgage brokers do, and how did they determine who got approved for a loan? After diving deep into the subject, Tyler made a startling discovery. Mortgage brokers often didn't need much more than basic personal information to process a loan application. There were huge gaps in the vetting process. Lenders could approve a loan based on inflated incomes, fabricated documents, and doctored credit scores, and many of these fraudulent details could easily go unnoticed by the overburdened financial institutions. Tyler's first attempt at mortgage fraud came when he was just 16 years old. He used a fake identity he'd crafted for himself online to apply for a small $50,000 loan to purchase an investment property. He inflated the income, doctored tax returns, and used a friend's empty house as a residence to make the loan appear legitimate. To his surprise, the loan was approved with no questions asked. Tyler took the money, bought a cheap house, and flipped it, selling it for $80,000. He pocketed a tidy $30,000 profit. The success was intoxicating, but Tyler knew he had only scratched the surface. He realized that if he could manipulate the mortgage system with minimal effort, there were others, grown adults even, who were doing far worse, inflating property values, misrepresenting financials, and outright lying to banks. Tyler's unique insight into the mortgage process and his technical know-how gave him an edge. It wasn't long before he decided to scale his operation into something much larger. The early years of the scheme, building the network, Tyler was smart, methodical, and incredibly persuasive. He knew that to succeed, he couldn't just keep running loans in his own name. That would draw too much attention. Instead, he began to recruit people. At first, it was just a few friends, fellow high school students and acquaintances whose personal details could be used for his applications. They were typically people who were too naive to question what he was asking them to do, often promising them a cut of the profits in exchange for their identities and a small fee for their trouble. Tyler would set them up with fake jobs and inflated incomes, forging tax returns and pay stubs for them. With their personal information in hand, He would apply for multiple loans under different names. The mortgage lenders, still reeling from the collapse of the housing market and not fully rebuilding their due diligence practices, were more willing than ever to approve loans without checking the fine details too thoroughly. By the time Tyler turned 18, he had already secured several $1 million in loans. He was buying homes, usually foreclosures or cheap fixer-uppers, and then flipping them for profits. However, his real breakthrough came when he learned how to manipulate not only individual loans but entire mortgage portfolios. He would pool together several properties under a single investment group, also fabricated, using multiple fake names, and apply for larger, more lucrative loans, sometimes for millions of dollars at a time. By the time Tyler was 19, he had gone from flipping houses on the side to running a full-scale mortgage fraud operation, using a network of fake identities, forged documents, and shell companies. Tyler was applying for loans in multiple states. He would target states with lax regulations or those still recovering from the housing crash, knowing that regulators were stretched thin. He targeted mortgage companies that were hungry for business, desperate to lend in an economy where many buyers couldn't qualify for traditional loans. One of his biggest coups involved a $3.5 million loan for a luxury apartment complex in downtown Cleveland. Tyler used a fake construction company, fake tax filings, and a fraudulent project proposal to convince the bank to fund the loan. He used his forged documentation to convince the lender that the property was worth far more than it actually was, and that the project was already halfway completed. In reality, the apartment complex was a dilapidated, abandoned building. Once the loan was approved, Tyler immediately liquidated the property, selling it off piecemeal and pocketing the cash. The lender, meanwhile, was left with a pile of worthless property and no recourse. Tyler didn't stop there. He expanded into commercial properties, buying entire office buildings and industrial warehouses. He used fraudulent appraisal reports to inflate the value of each property, often quadrupling the asking price. Banks and lenders approved loans for these properties, believing they were sound investments. He took the funds, paid off the original mortgages, and pocketed the difference. By the time Tyler was 21, he had accumulated over $20 million in loans. He was living a life that most people could only dream of: expensive cars, a mansion, lavish vacations, and a lifestyle that would have been impossible on his legitimate income. He even started laundering the proceeds, using shell companies in the Cayman Islands and funneling money into overseas bank accounts. Tyler had gotten so comfortable with his operation that he began to take risks he never would have taken before. He started to apply for loans that were far too large, using fraudulent income statements and fake business ventures. He began to mix personal investments with the fraudulent ones, often using the proceeds to fund luxury purchases and partying at exclusive venues. It wasn't long before his name started popping up on the radar of some very suspicious financial institutions. His downfall came when he tried to apply for an $8 million loan for a series of commercial properties in a rapidly gentrifying area in Detroit. The property was real, but Tyler had massively inflated its value, falsely claiming that it was already fully leased to high-profile tenants. When the bank's underwriters began digging deeper, they found discrepancies, falsified lease agreements, inflated property appraisals, and phony income statements. The bank immediately flagged the loan and launched an investigation, which quickly uncovered a web of fraud stretching across several states. As investigators traced Tyler's operations, they found multiple properties in various stages of fraudulent refinancing, each one linked back to him in some way. His use of fake identities, fabricated companies, and doctored documents was staggering, and the total value of the fraudulent loans was estimated to be over $50 million. At 22, Tyler Matthews was arrested in a joint operation between the FBI and the Department of Housing and Urban Development, HUD. He was charged with wire fraud, mortgage fraud, identity theft, and money laundering, among other crimes. The investigation revealed just how deep his operation had gone. He had manipulated nearly every aspect of the mortgage system and had caused losses in the tens of millions. Tyler's arrest shocked the local community. The kid who had once seemed like a regular high school student turned out to be one of the most sophisticated criminals in the country. The story made national headlines, with people stunned by the sheer audacity of a teenager outsmarting one of the largest financial systems in the world. In court, Tyler showed little remorse. He had lived a lavish life, but now he faced decades in prison. He was sentenced to 25 years for his role in the largest mortgage fraud scheme ever perpetrated by someone his age. The case was a wake-up call to the financial industry, prompting major reforms in mortgage lending practices and a renewed focus on compliance. Despite his downfall, Tyler Matthews became a legend of sorts in the world of cybercrime. His story was both a cautionary tale and an example of how easily the system could be manipulated by someone with the right knowledge and skills. In the midst of the 2008 global financial crisis, when the world's credit markets were reeling and the collapse of Lehman Brothers had sent shockwaves through the economy, one man managed to exploit the chaos in an entirely different way, by intentionally crashing credit systems and making millions in the process. His name was Jack the Phantom Gray, a man whose financial schemes were so audacious they seemed almost like an elaborate heist in a thriller. Jack, in his early 30s, wasn't a traditional criminal. He didn't hack systems or rob banks. Instead, he leveraged his deep understanding of the financial world, the impending collapse, and human psychology to orchestrate a massive credit manipulation scheme. What he did wasn't just fraud, it was a full-on assault on the credit system itself. Jack Gray was a former Wall Street analyst turned rogue financial strategist. Having worked for several prestigious investment banks, Jack was no stranger to high-stakes finance. But it wasn't the rush of making money legally that excited him. It was the idea of how easy it was to manipulate the financial system when no one was paying attention. In the years leading up to the crisis, Jack noticed that major banks and financial institutions had become increasingly careless with their lending practices, offering high-risk loans to individuals with no regard for their ability to pay them back. It was a dangerous game of over-leveraging, inflated property values, and loose regulations, and Jack saw an opportunity. He wasn't looking to scam individuals directly. He wasn't trying to steal from the poor or from the average person. Instead, Jack targeted the very system that was supposed to protect people from financial ruin: the credit bureaus and the financial institutions. To him, the collapse of the housing market and the resulting recession were just opportunities waiting to be seized. Jack's plan wasn't just to manipulate individual credit scores. He wanted to crash entire credit systems in a way that would create a massive ripple effect, draining billions from the global economy. But how could he pull off something this grandiose? Jack's strategy was as brilliant as it was chaotic. The first part of his plan involved a deep dive into the world of credit scores, ratings, and risk models. In order to crash credit markets, he knew he needed to target the very infrastructure of credit systems, the models that dictated who got loans, the formulas that calculated risk, and the databases that tracked and rated individuals' financial histories. To do this, Jack created a network of fake identities, each one with a full history of financial misdeeds that were expertly manipulated to appear real. His goal was not to just tamper with individual credit scores, but to inflate the risk assessments of entire blocks of individuals in a specific demographic. If he could flood the system with false high-risk individuals, credit scores would plummet, leading to widespread panic. Jack began with a handful of well-placed insiders, a corrupt credit analyst, a low-level employee at a major bank, and an ex-finance professor with a penchant for obscure financial theories. Using his inside network, Jack exploited their positions to acquire vast amounts of personal financial data, including credit card histories, loan applications, and bank statements. Using this data, he forged hundreds of fake identities with doctored credit histories. He fabricated bankruptcies, late payments, and fraudulent accounts for each of these identities, then strategically placed them into databases of high-risk individuals. These fake histories were then linked to real accounts that weren't flagged and were often approved by the system without further scrutiny. He effectively gamed the system by blending real and fake data in such a way that the algorithms failed to detect the fraudulent information. Next, Jack used a series of shell companies and fake social security numbers to apply for lines of credit at various banks, claiming massive debts that didn't exist. The banks, eager to make quick approvals, issued large loans and credit lines without properly verifying the legitimacy of the information. Jack would then default on these loans almost immediately, leaving the banks with millions in unpaid debt. The banks began to feel the weight of the growing defaults, and as their portfolios became overloaded with non-performing loans, they started raising interest rates to cover the losses. At the same time, Jack began a campaign of deliberate defaults by staging a series of failed mortgages and maxed-out credit cards, which he intentionally defaulted on. Each default added to the sense of a brewing credit crisis. Within months, his actions caused credit scores to plummet for thousands of individuals, creating false data spikes that sent the entire credit reporting system into a tailspin. With the system already fragile from the broader economic crisis, Jack's tampering had a dramatic effect. Credit ratings began to shift rapidly. People with strong financial histories were suddenly classified as high risk, while those with no credit history at all saw their scores plummet due to the false defaults Jack had engineered. Banks responded by tightening their lending practices, refusing loans even to low-risk individuals. Mortgage lenders began rejecting applications, causing an artificial credit freeze, and businesses could no longer access the loans they needed to grow or expand, while average Americans were locked out of homeownership and business opportunities. The ripple effects were catastrophic, especially for the working class, who depended on loans for education, homes, and vehicles. Meanwhile, the stock market began to reflect panic as investors feared the knock-on effects of a massive liquidity crisis. At the same time, Jack's manipulation of the system made its way into credit default swaps, CDS, and collateralized debt obligations, CDOs, complex financial instruments that were tied to the health of the credit market. Using these, Jack profited massively from the implosion of the credit system. He bet on the collapse of major financial institutions by using his manipulated data to trigger a series of margin calls, forcing banks to sell off their assets at steep discounts to meet short-term liquidity requirements. He made millions on these transactions, and by the time the full scale of the credit crash became apparent, Jack had already moved most of his wealth into offshore accounts and untraceable assets. But Jack wasn't just watching from the sidelines. He was actively short-selling financial stocks and betting against companies that were tied to the mortgage and credit industries. As the public fallout from the credit crash spread, the stock prices of these companies plummeted. Jack cashed out of his short positions, making tens of millions of dollars in the process. Jack had done something that no one had ever anticipated. He'd used his insider knowledge, the very financial systems that were supposed to regulate the economy, and turned them against themselves. His manipulation of the credit system had not only devastated financial institutions, but it had also sparked a wave of regulatory reforms, forcing governments and banks to drastically rethink how they managed credit ratings and loan applications. But Jack wasn't completely untouchable. His shell companies and fake identities began to unravel as investigators followed the money trail and realized the pattern of defaults was too calculated to be purely accidental. However, by the time authorities had pieced together the full scope of Jack's operation, he had already disappeared. He had laundered his money through a series of international shell companies, stashing it in hidden accounts across Europe and the Caribbean. His false identities made him virtually invisible. Jack's disappearance left the authorities baffled. No one could figure out how a single man had managed to bring down such a large part of the financial system with just a few months of deliberate manipulation. Even though the public knew that the crash had been triggered by widespread credit defaults, no one understood the true scale of the behind-the-scenes manipulation that had started it all. The financial markets eventually recovered, but not without significant regulatory overhauls. Dodd-Frank and other legislation were put into place to prevent another collapse, but Jack's identity remained a mystery for years. His name became synonymous with the mysterious phantom that had brought down the credit system during the height of the financial crisis. Though Jack's exact whereabouts remain unknown, his legacy is a reminder of how fragile the systems that underpin our economy really are. His story showed that with the right combination of insider knowledge, manipulation of financial instruments, and sheer audacity, even a single individual could wreak havoc on the global economy and make millions, without ever having to physically steal a dime. In the years since, Jack Gray's name has faded into the annals of financial legend, and his methods have been studied by regulators and criminals alike. It's a wild tale of how someone exploited the cracks in a broken system, left chaos in his wake, and walked away richer than most people could ever imagine. In the early 2012, amidst the economic recovery following the 2008 financial crisis, a man named Sam McAllister, once a small-time entrepreneur and aspiring business consultant, managed to build a multi-million-dollar empire using fake business credit. His audacity, knowledge of the credit system, and manipulation of loopholes allowed him to exploit the world of finance and scam lenders and investors in ways that seemed impossible. But like all grand schemes, Sam's empire came crumbling down, and his name became infamous as one of the most notorious con artists to ever game the system. Sam McAllister didn't start out as a criminal. Born in a working-class neighborhood in New Jersey, he was the son of a mechanic and a secretary. Growing up, Sam had always been fascinated by the world of business. He wasn't particularly good at academics, but he had a natural flair for selling, networking, and talking his way into deals. After graduating from high school, he dabbled in various small business ventures, none of which took off. He sold electronics online, tried his hand at drop shipping, and even briefly attempted a food truck business. All of them failed, but the experiences gave him a unique insight into the world of business loans and financing. It was during his years of small-time hustles that Sam learned one important thing. Business credit was the lifeblood of entrepreneurship. Business credit, unlike personal credit, was far less regulated and more difficult to track. If a company could establish a strong credit profile, it could borrow significant amounts of money, even without any real assets. Sam's first experience with business credit came when he applied for a small loan to fund a failed electronics venture. Though he didn't have much to offer in terms of collateral, he was able to convince a small lender to approve him, using a vague business plan and inflated revenue projections. When Sam's electronics venture collapsed within a year, he defaulted on the loan. However, rather than facing harsh consequences, Sam quickly realized that the financial system was riddled with loopholes. He saw how easily it was to manipulate the information required to secure credit. This revelation changed everything. If he could manipulate the system to get more loans without any intention of paying them back, he could live the life he had always dreamed of. Sam started his scheme modestly. He created a few fake LLCs, limited liability companies, each with a fictitious business name and website. He applied for business credit cards and small loans under these fake companies, using doctored financial documents, inflated revenue projections, and even fictitious employees. These initial applications were small, $5,000 here, $10,000 there, but they were enough to give Sam a taste of what was possible. What made Sam's plan so clever was that, unlike personal credit, which was heavily monitored, business credit was often more difficult to trace and verify. He would apply for a business credit card or a line of credit, claiming that his fake companies had strong credit histories, when in reality, they didn't exist at all. Banks and lenders, hungry to lend money and take advantage of the recovery period after the crash, didn't ask many questions. By the time Sam turned 30, he had set up over 10 fake businesses, each with its own EIN, employer identification number, business address, and bank accounts. He systematically applied for business lines of credit with major banks, offering up falsified financial statements, fabricated business plans, and doctored tax returns. He had learned how to game the system, how to create the illusion of legitimacy. The trick was simple. Never use the same fake identity twice and constantly keep moving the money around. Sam began receiving large sums of money from credit lines, which he would use to buy assets, real estate, cars, luxury goods, and, importantly, high-end electronics and equipment. He didn't care about the businesses themselves. He didn't even try to make them profitable. He just used them as tools to unlock more credit, more loans, and more assets. For each new fake company, Sam would establish a business credit profile through credit bureaus like Dun and Bradstreet. By securing small amounts of trade credit with vendors and suppliers, he would then use these trade lines to build up his credit score, making it look like his businesses were solid, profitable ventures. Once his fake businesses had strong credit histories, he could apply for larger, more substantial loans. Over the course of 2 years, Sam's scheme grew exponentially. His fake businesses, manufacturing companies, tech startups, distribution companies, each appeared to be thriving. He would apply for business credit cards, lines of credit, and merchant cash advances from a variety of sources. He used each new loan to fund personal expenses and further enrich himself, buying more luxury cars, properties, and real estate. He took out massive loans, some as large as $1 million, and funneled the funds into high-return assets like residential properties and stocks. He had become a master at creating fake financial documents that convinced even major banks and private investors that his businesses were profitable. Banks rarely questioned the loans once they saw the fabricated financial records and the successful credit history of his fake businesses. When they did question something, Sam had an answer. Whether it was a fake tax return or a doctored bank statement, he always had an explanation. With his fake companies generating millions in credit, Sam started taking out large loans for properties in rapidly developing areas, often flipping these properties for huge profits. He would sell the properties quickly, using the proceeds to pay off other business loans, creating the illusion of success. In the meantime, he lived lavishly, throwing parties, buying high-end cars, and flying around the world in private jets. He was untouchable, living the life of a billionaire without ever having to deliver a single product or service. But the true scale of his operation came to light when Sam used fake business credit to acquire entire office buildings in prime locations in New York City and Miami. He applied for construction loans under these fake businesses, claiming that he was building tech startups or expanding manufacturing facilities. The construction loans were approved for millions of dollars, and Sam, using his network of lawyers and accountants, funneled the money through offshore accounts and shell companies. He then hired contractors to perform only basic repairs on the properties, while the rest of the funds went into high-yield investments, stock options, cryptocurrency, and international ventures. Each time he sold or refinanced a property, he generated millions more, which he used to fund new loans and further hide his ill-gotten wealth. Sam had created an empire built on nothing but fraudulent credit. He was living in a world of smoke and mirrors, and his greatest mistake was believing he could keep it going forever. As his wealth and portfolio grew, so did the attention he was getting from investors and even real estate professionals. Sam started bragging to colleagues about his success, claiming he was the owner of several thriving companies, while in reality, everything he had was built on a foundation of lies. But his downfall began when he took out a massive $10 million loan from a private equity firm for a new development project. The investors, eager to get in on the booming real estate market, did little due diligence. When Sam failed to make the first payment, the investors grew suspicious. They demanded to see the financials of the companies he had listed as collateral, and this is where his operation began to unravel. The private equity firm hired an independent auditor to review Sam's financials, and when they dug deeper, they found a trail of discrepancies, phony tax filings, faked revenue projections, and non-existent business operations. The auditor also discovered that Sam had been using fake ENs and redirecting payments to overseas bank accounts. When the firm attempted to seize Sam's assets, they found that many of the properties Sam had listed as collateral were over-leveraged and worth far less than he had claimed. Worse still, several of his so-called businesses had no real operations, employees, or products to speak of. The credit lines Sam had built up were based on falsified financials and fabricated identities. Authorities quickly got involved, and what they uncovered was staggering. Sam's entire empire was a house of cards. The FBI, SEC, and Department of Justice launched a full-scale investigation. They traced the fake businesses, the phony loans, and the fabricated financial documents back to Sam. Within weeks, Sam was arrested at his Manhattan penthouse, surrounded by his lavish assets, none of which were actually his. Sam McAllister was charged with wire fraud, identity theft, money laundering, and conspiracy. The amount of fake business credit he had obtained was estimated to be well over $50 million, and he had siphoned off millions of dollars into his personal accounts. The authorities also discovered that he had used his fake businesses to inflate property values and manipulate real estate deals, leading to further criminal charges. Sam's arrest made national headlines. The Shadow King of business credit had been brought down, and his story served as a warning to anyone who thought the system could be gamed forever. In court, Sam pleaded guilty to multiple charges, and he was sentenced to 25 years in federal prison. His empire was dismantled, and the money he had stolen was largely recovered, though much of it had already been hidden in overseas accounts. Sam McAllister's story remains one of the most elaborate credit fraud schemes in modern history. His name became synonymous with deception and hubris, proof that, even in the world of high finance, a single person could use the right knowledge, connections, and manipulation of the system to make millions. Today, Sam's tale serves as a cautionary one for anyone looking to build wealth through deceit and fraudulent credit. In the mid-2000s, a man named Vincent the Phantom Trustee Black rose to infamy in the financial world. What started as a series of small financial manipulations grew into an empire built on bankruptcies, trust funds, and legal loopholes. His audacious schemes led to millions of dollars in fraudulent assets, and he lived a lavish life until the law caught up with him. Vincent's story became the stuff of legend, one where a man gamed the system with ease, exploiting its weaknesses until the truth came crashing down. Early life, the mind of a manipulator. Vincent Black wasn't born into wealth. He grew up in a modest household in suburban Pennsylvania, the son of a high school teacher and a nurse. As a child, Vincent showed an aptitude for puzzles and patterns, often spending hours solving logic games and crosswords. As he got older, this knack for problem-solving morphed into an obsession with legal loopholes and financial structures. By his late teens, Vincent had developed a deep understanding of bankruptcy law, trust funds, and the way wealthy individuals managed their assets. After finishing high school, Vincent enrolled at a small college to study business and finance. However, he quickly grew disillusioned with the formal education system. While his classmates spent their time memorizing theory, Vincent was focused on something much more practical, understanding how money moved through the legal system and how people used bankruptcy filings to offload debt and protect us assets. While most of his peers worked entry-level jobs, Vincent started advising local business owners on how to navigate bankruptcy filings. He was only 22, but his knowledge of Chapter 7 and Chapter 11 bankruptcies was unmatched. It was this knowledge that would soon allow him to manipulate the system in ways that few could fathom. The early schemes, faking bankruptcy for personal gain. Vincent's first taste of true financial manipulation came when he encountered a small business owner, Dave Armstrong, who was struggling with mounting debt. Dave had a printing business that was failing, and the bank was threatening foreclosure. Vincent saw an opportunity, not just to help Dave, but to set up a model for his future operations. Vincent advised Dave to file for Chapter 11 bankruptcy, a process usually reserved for businesses looking to restructure their debts. While most businesses used Chapter 11 to try to stay afloat, Vincent had a different idea. He helped Dave file for bankruptcy, but not with the intention of saving the company. Instead, they used the legal loopholes in the process to shield assets from creditors. The business was shuttered, but Vincent had Dave transfer ownership of a few key assets, a collection of high-end printing equipment, to a new trust, which Vincent himself controlled. This trust was created under a vague name, something that appeared legitimate but had no real activity behind it. The trust was set up with a separate legal entity as the beneficiary, making it difficult for creditors to track. As a result, the equipment was protected under the bankruptcy filing, and Vincent was able to sell the assets to a third party without anyone suspecting a thing. The proceeds from the sale were funneled through a network of shell companies and trusts, making it nearly impossible to trace. Dave's bankruptcy was messy, and Vincent moved on to the next. Word of his success spread quickly, and soon more business owners came to him, each hoping Vincent could help them escape their financial troubles, or at least make them profitable in some other way. Vincent had found his niche, using bankruptcies as a tool for asset protection and wealth generation, expanding the operation, creating phantom trust funds. By his mid-20s, Vincent had built a network of businesses and individuals who were willing to use his services. However, he didn't want to stop at just bankruptcies. He began to experiment with trust funds, particularly those tied to family estates and inheritance. Trust funds were an extremely lucrative vehicle for hiding assets and controlling wealth, especially for high-net-worth individuals. Vincent's first trust fund operation was with a wealthy businessman named Richard Crane, who owned a successful chain of hotels. Richard had inherited millions from his family, but had become embroiled in a series of bad investments. He was on the verge of losing everything when he reached out to Vincent for advice. Vincent quickly saw that the Crane family estate could be protected through a series of legal steps involving irrevocable trusts. What Vincent did next was a masterpiece of financial manipulation. He convinced Richard to create a fake family trust, one that didn't exist on paper but had the appearance of a legitimate financial instrument. The trust was set up with a shell corporation as its beneficiary and included a complex offshore account in the Cayman Islands. Using legalese and a few well-placed financial maneuvers, Vincent was able to shift assets from Richard's personal holdings into the fake trust, thereby protecting them from creditors. Then came the bankruptcy filing, this time for Richard's hotel business. The bankruptcy was real in its formalities, but it was only a tool for Vincent to shield assets. The property was sold off, but the money was quickly routed to the trust. Since the trust was technically out of reach of the U.S. courts, Vincent was able to secure millions in real estate and cash, all while keeping Richard's name clear of any liabilities. In this case, Richard Crane ended up with a smaller but sustainable portion of his original wealth, while Vincent took a large cut for orchestrating the entire scheme. But Vincent didn't stop there. He used this method to build a massive portfolio of assets, all moved into various trusts he controlled. These trusts allowed Vincent to hide money, avoid taxes, and shield assets from lawsuits or creditors. Vincent's success with Richard Crane opened doors to the wealthiest circles. He became known as the Phantom Trustee, a man who could make millions disappear into the ether of offshore accounts and fake trust funds. As his reputation grew, Vincent began creating even more elaborate schemes. He started advising wealthy families, business owners, and investors on how to shield their assets from creditors, lawsuits, or simply bad business decisions. One of Vincent's most audacious moves involved a group of tech entrepreneurs who were facing significant debt after a failed venture. These entrepreneurs had made millions in the dot-com boom, but had fallen victim to the burst of the bubble. They were looking for a way to protect their wealth while legally filing for bankruptcy. Vincent promised them a solution, a way to not only protect their assets, but to ensure that their families would never feel the sting of their business failures. He guided them through setting up an elaborate series of interlocking trusts and family foundations, each with a seemingly legitimate purpose, but ultimately serving to obscure the true ownership of their wealth. He created offshore entities, funneled money into anonymous shell corporations, and placed valuable assets, real estate, stocks, private equity stakes, under foreign trusts with beneficiaries listed under fake names. For these entrepreneurs, bankruptcy was no longer a tool for debt relief. It became a way to launder wealth. Vincent made sure to maintain the appearance of legality, constantly shifting assets between entities and using complex trust agreements to obscure the true ownership. Meanwhile, creditors were left empty-handed, unable to penetrate the maze of trusts and offshore holdings that Vincent had built. By the time he was in his early 30s, Vincent had amassed a fortune that was impossible to trace. He owned properties in multiple countries, a private jet, a fleet of luxury cars, and enough offshore accounts to fund a lifetime of lavish living. What made Vincent's success so impressive was his ability to remain under the radar. He never involved himself directly in the management of any of the businesses he helped bankrupt. Instead, he kept his distance, hiding behind the facades of trusts and shell companies. However, as Vincent's wealth grew, so did the complexity of his operations. His use of bankruptcy and trusts had attracted attention from the wrong people. Federal investigators, tax authorities, and creditors who were starting to question the sudden disappearance of assets in multiple, high-profile bankruptcies. Vincent's first major slip-up came when a whistleblower from one of his fake trust funds tipped off the IRS. The whistleblower had been a part of a network of financial professionals who had become suspicious of Vincent's activities. Once the IRS started looking into Vincent's operations, they quickly realized that many of the assets he had moved into offshore accounts were overstated and based on fabricated documents. The authorities began tracking his financial movements, but by the time they connected the dots, Vincent had already moved most of his wealth to a network of accounts and shell companies across multiple countries. He used false identities, multiple law firms to act as fronts, and false paperwork to keep his wealth concealed. But the IRS and the FBI had their sights set on him, and they began to unravel the web. It took nearly 5 years for investigators to catch up with Vincent. But eventually, they did. When the authorities raided his properties and froze his accounts, they found millions in assets, real estate, stocks, and private equity stakes, all hidden within a complex maze of trusts, shell corporations, and offshore accounts. The total amount of money Vincent had defrauded from creditors, the government, and investors was estimated to be well over $100 million. Vincent Black was arrested on charges of money laundering, fraud, tax evasion, and conspiracy. His empire collapsed, and his assets were seized by the U.S. government. In court, Vincent was sentenced to 20 years in federal prison for his role in orchestrating one of the most elaborate financial frauds in modern history. Vincent, the Phantom Trustee. Black became a cautionary tale for those who believed they could game the system indefinitely. His story is often cited as a prime example of how individuals can manipulate bankruptcies and trust funds to hide wealth, avoid taxes, and defraud creditors. His downfall came not from his schemes themselves, but from the fact that he had pushed the system too far, creating a web of deceit so complicated that it ultimately became his undoing. Jared Mitchell was a man of ambition. He grew up in a middle-class neighborhood in Detroit, Michigan, but quickly realized that his life wasn't going to follow the same path as everyone else's. While his friends worked regular jobs or pursued higher education, Jared was always scheming, looking for shortcuts to success. By the time he was in his late 20s, he had built a network of shady connections and mastered a financial loophole that would allow him to manipulate the credit system and make millions. His weapon of choice? A credit profile number, CPN, and with it, he was able to secure loans, buy luxury properties, and fund lavish lifestyles, all built on fraud. This is the story of how Jared the Ghost Mitchell rose to infamy using a CPN and fraudulent loans, only to watch his empire crumble under the weight of his own greed and deception. Jared was never satisfied with the slow grind of everyday life. He had dropped out of college after one semester, finding the structure of academia stifling. Instead, he dove into the world of finance, but not the way most people do. He wasn't interested in stocks or bonds. He was interested in credit, specifically how he could get loans without the traditional means of building good credit. It wasn't long before Jared discovered the concept of a CPN, a credit profile number. CPNs are often marketed as a way for people to start fresh with a new credit profile, bypassing their old, damaged credit. They are often sold as a legitimate alternative for people looking to fix their credit or start a new financial chapter. The problem, however, is that CPNs are illegal when used to create a new credit profile for the purpose of securing loans or credit under false pretenses. Jared wasn't interested in fixing his credit. He wanted to create a new identity that would allow him to borrow money and take out loans that he had no intention of paying back. A fresh start, but with other people's money. He knew the risks, but to Jared, the rewards outweighed them. He started buying fake CPNs from online forums and shady credit repair services. These CPNs were essentially fraudulent Social Security numbers that could be used to create new credit profiles. Jared would use these new identities to apply for loans and credit cards, keeping the original number out of sight. Once Jared acquired a few CPNs, he began applying for credit cards, personal loans, and even auto loans under these new identities. He was meticulous. Jared knew that to make his scheme work, he had to look credible. He created fake addresses, fabricated employment histories, and generated false pay stubs to submit with his loan applications. Each time he applied for credit, he would use a different CPN, avoiding any patterns that could be traced back to him. His initial success was modest, but it was enough to keep the wheels turning. With a few $1,000s in credit card limits and small loans, Jared started to build a financial foundation, purchasing luxury items, expensive cars, and electronics that he could sell quickly for cash. But his real goal was always the same: large-scale loans. One day, Jared hit the jackpot. He was able to secure a $50,000 personal loan using a CPN, claiming that he was a high-level executive at a company he made up. With that money, Jared bought several high-end vehicles, luxury cars like Mercedes-Benz, BMW, and Lexus, and flipped them for a quick profit. But Jared didn't stop there. He knew that if he could scale up his operations, the rewards would be limitless. By now, Jared had learned how to manipulate the system to his advantage. He started targeting lenders who specialized in hard money loans, loans that were secured by real estate. These types of loans didn't require a strong credit history, just collateral and a solid business plan. Jared was able to secure several loans for investment properties using his CPNs and fabricated personal histories. He bought distressed properties, houses in need of serious renovation, and used the loan money to flip them for massive profits. Over time, he started buying multiple properties in different neighborhoods, each one secured by loans tied to fake identities. To the banks and lenders, Jared appeared to be an investor with a strong portfolio of properties. In reality, the properties were mortgaged up to the hilt, and Jared had no intention of paying back the loans. He expanded into commercial real estate, securing large loans for office buildings and retail spaces under his CPNs. Jared even convinced a few lenders to fund construction projects that were never completed. His method was simple. Use the CPN to apply for the loan, give the appearance of success, and then take the funds without ever completing the project. He lived lavishly, funding his lifestyle with the money he had taken from these loans. $1-million penthouses, private jets, and exotic vacations became his new normal. As Jared's empire grew, so did his ego. What had started as a simple way to escape his financial struggles turned into a desire for more. Bigger loans, larger properties, and more luxury goods. Jared stopped being cautious, and he began pushing the boundaries of his fraud. He started applying for business loans for companies he had no interest in running. He created fake limited liability companies, LLCs, with fabricated financials and false tax returns. He used these companies to apply for $500,000 loans, lines of credit, and even business credit cards, all backed by fraudulent identities. Jared used the funds from these loans to buy more property, fund lavish investments, and hide money in offshore accounts. But the most ambitious project Jared ever undertook was a $10 million loan for a real estate development project. He presented the project as a luxury condo complex in an up-and-coming area, complete with detailed architectural plans, investment projections, and a phony history of success. To sweeten the deal, he even created fake partner companies and investors who supposedly had a stake in the project. The lender, seeing the supposed financial backing and solid plans, approved the loan without hesitation. But Jared had no intention of ever building a single condo. Instead, he used the funds to purchase a massive mansion, buy more cars, and set up more fake companies that he could leverage for additional loans. Jared's downfall began when one of his many loans went into default. In one of his smaller real estate ventures, he used a CPN to secure a loan for a property he bought in Miami, but the property value plummeted after a real estate market crash. The bank tried to reach him for repayment, but when they couldn't track him down, they began digging deeper into his loan history. What they found was a web of lies, fake businesses, false addresses, and multiple CPNs used for loans. Soon other banks began noticing discrepancies in their dealings with Jared, and the FBI was tipped off by one of Jared's former lenders. The more the authorities dug, the more fraudulent activity they uncovered. Jared had used dozens of CPNs to secure millions in loans that had no chance of being paid back. The FBI arrested Jared at his New York City penthouse while he was celebrating his latest venture, a luxury yacht he had just purchased. Investigators found that Jared had defrauded multiple banks and lenders out of an estimated $20 million. His assets, including real estate, luxury cars, and high-end electronics, were seized and liquidated to pay back a fraction of what he owed. Jared Mitchell's story became a cautionary tale of how CPNs, though marketed as a way to start fresh or rebuild credit, could be used to commit massive fraud. His use of fake identities, bogus loans, and manipulation of the credit system left banks and lenders with millions of dollars in losses. He had lived the life of a high roller, all while hiding behind a series of lies and fraudulent documents. In court, Jared was charged with wire fraud, identity theft, money laundering, and conspiracy. He was sentenced to 15 years in federal prison. His empire built on fake credit profiles and fraudulent loans, came crashing down in a matter of months, leaving behind a trail of destroyed lives and financial institutions reeling from the impact. As for Jared, he became a symbol of how one man's greed and manipulation of the system could lead to millions of dollars in fraud, and ultimately his own downfall. The rise and fall of Jared the Ghost Mitchell serves as a stark reminder of how easy it can be to exploit the financial system and how dangerous it is to play with someone else's money.